Alright guys, so I hope you're doing fine as always. Today I'm making another video about funding rates and funding fees, as requested in the comment section on the previous video. So without further ado, let's jump straight into the video. So first of all, what are funding rates and funding fees and how do they work? So funding rates are often referred to as funding fees, are nothing more than a payment made between traders in a futures market, especially in the perpetual contracts. This is to ensure that the contract price stays close to the underlying asset price, also known as the spot prices. So unlike traditional future contracts that have an expiration date, these perpetual contracts are designed to be held indefinitely. And this is the reason why we have these funding rates in order to help balance the demand between long and short positions. So that's very important to know, is because we can hold these perpetual contracts for however long that we like, we have these funding rates in order to keep some type of balance in place. So if we now have a deeper look into these funding rates, then we can say that these rates are paid directly between traders with an opposing position. So this means that there is no exchange in the middle of this. So it's not that you pay the fees to your exchange and the exchange will then distribute them, but these fees will be paid directly between people in a long and a short position. So we can split these funding rates into two types, either a positive funding rate or a negative funding rate. If our funding rate is positive, this will mean that people in a long position will be paying people in a short position. The other way around, when the funding rate is negative, this means people in a short position will be paying people in a long position. So for example, if the funding rate is positive and you're in a long position, that means you will be paying every X amount of time the people in a short position the funding fees. But if this funding rate is positive and you're in a short position, this means you will receive the funding fee from the people in a long position. So that's very important to keep in mind, but we will come back to this later. Now, how are these funding rates determined? So the funding rate is usually just a combination of the interest rate and the premium or discount between the perpetual contract and the spot price of the underlying asset. So we can have an overview here in this table on the slide. So if the perpetual price is higher than the spot price of the underlying asset, we can call this a premium. If this is the case, then the funding rate tends to be positive, which results into people in longs will be paying people in shorts. And this is in place just to encourage people to go short or encourage people to open shorts just to bring back the balance and try and get this perpetual price back down to the spot prices. The other way around, if the perpetual price is lower than the spot price, we can call this a discount. Here the funding rates will tend to be negative, meaning that people in short positions will be paying people in long positions in order to encourage people to go long, in order to drive the prices back up to the spot price of the underlying asset. So now, how often do these funding fees occur? So funding fees are typically charged at regular intervals. On most exchanges, at least that I have seen personally, it's every 8 hours. But maybe there are exchanges out there that have different time intervals, I don't know, but the most common one is 8 hours. Now, what's the purpose of these funding rates and funding fees? We kind of went over this already, but here's an other slide to summarize it again. So the primary purpose of these funding rates and funding fees is to align the price of the perpetual contract with the underlying spot prices. So they try to balance the spot price and the perpetual prices so they're becoming equal. This mechanism is put in place just to prevent significant differences between the two prices, and it's to ensure that the contract prices are just a practical tool for speculation and hedging. So that's important to know, that these perpetual contracts are nothing more than a tool for speculation and hedging. So now what are the implications for us as traders of these funding fees? First of all, the cost of holding a position. You will either have to pay or get paid to have a position open. Like we went over previously, this will depend if you're in a long or a short position, and if the funding rates are positive or negative. Second of all, what we have to keep into account is the volatility of these fees. Funding rates or funding fees can vary significantly based on market sentiment. For example, based on supply and demand, or based on subtle price movements. And last but not least, we can build a strategy around this. So traders can use these funding rates as a signal for market sentiment. So for example, if we see consistently high positive rates, that may indicate we have a bullish market sentiment. But keep in mind, market makers and institutions will also know this. So they can use this in order to create liquidity as well. So now let's just see some examples of these funding rates. So in this example, we have a funding rate of 0.01% positive, which is normal for Bitcoin, let's say, on usual boring days. So now let's say that you open a long position with a margin of $100 on 5x leverage. So your total position size will be $500. So the funding rate is positive. You hold the long position. So this will result into that you have to pay a funding fee every 8 hours on most exchanges. Again, this time can be different on different exchanges, but as far as I know, I've only seen 8 hours. So this will eventually result into that you have to pay 5 cents every 8 hours. Keep in mind, if the funding rate would have been negative 0.01%, you would receive this 5 cents every 8 hours with your long position. On the screen, you can see the calculation of this. So we have the position size, which is $500, times the funding rate in percent, which results into the fee you have to pay or receive. You can see this is very small. So on your margin of $100, you only have to pay 5 cents every 8 hours, which is totally fine. Now let's have a look at the second example, where the funding rate is at positive 2%. So you will see these high funding rates on usually smaller coins that had a very big price movement. So let's say you also here have a long position of $100 margin on 5x leverage, so a $500 position size. The funding rate is positive, so we have a long open, which will result into that we have to pay this funding fee every 8 hours. But because the funding rate is this high, this will already result into that we have to pay a $10 fee every 8 hours. So if we compare that to the previous 5 cents that we have to pay on a $100 margin, or already $10, you could see this is already a huge difference. So this puts already a bit of pressure on top of our position, or on top of our margin. Keep in mind if the funding rate was here negative 2%, we would receive $10 every 8 hours. So now that we know the theory behind these funding rates and how they're calculated and why they're there, we can have a look at funding rate squeezes and how we can use the funding rate and read the funding rates into our advantage and how to understand them. So if we see coins with high funding rates, either negative or positive, doesn't matter, just need to be high, this will usually mean that significant fees need to be paid, putting a lot of pressure on the people that need to pay these funding fees. This can then therefore force liquidations. So if the funding fees are high for an extended period of time, the maintaining cost of these positions will be increasing, putting even more pressure on the people holding these positions, almost forcing them into liquidations, or forcing people to add on to their position. So then, after this, we're looking for a price divergence and reversal. So high funding rates often indicates an imbalance in the market. For example, there might be too many longs or too many short positions. So when a funding rate squeeze occurs, that can lead to a sharp price reversal as the imbalance corrects itself. So that's very important to understand. So once the funding rates are squeezed, meaning they're going back to normal, we can see a very sharp price reversal in order to balance itself again. So knowing all of this, we can see there's a lot of opportunity or potential for market manipulation. Institutions or market makers can exploit these high funding rates by forcing a squeeze and forcing a liquidation or a stop run. So they can force all these people out to then have the sharp price reversals. So knowing all of this, we can make a separation of two common scenarios. So high positive funding rates. With high positive funding rates, it's suggesting to us that long positions are dominant. So prices can continue to drop in order to squeeze out these long positions. Once these long positions are squeezed out, the price can go up quickly in order to restore the balance. On the other side, if the high negative funding rates are there, high negative funding rates suggest to us that short positions are dominant, meaning in order to squeeze these shorts, price can continue to move up. So if prices continue to go up, they're squeezing out these shorts, liquidating them or stopping them out. So then once these shorts are squeezed out, the prices can drop sharply again to balance itself. These are the two common scenarios. We will have a look at some TradingView examples in a little bit. So now finally, how can we spot these rate squeezes and how can we use them into our advantage? Here we have 3 steps, with the most important steps being 1 and 2. So first of all, we're going to look for unusually high funding rates. So we're going to look for spikes in the funding rates that are way above the normal levels. This will be, for example, a 1.5% funding rate or 2%, 2.53. I've even seen 4% funding rates, which is absolutely insane. The normal levels, for example, for Bitcoin will be like 0.01%. For smaller coins, they can be 0.05% or 0.1% even, which is still normal, I would say. But once we see this 1.5%, 2%, 3%, and so on, this is very unusual and very high. So for step 2, we're going to look for a strong up and down trend in combination with these extreme funding fees from step 1. So we want to see very high funding fees and a very aggressive price movement up or down. As step 3, which I personally don't really use, but can be another interesting part of it, is looking at the open interests. So a fast increase or decrease in open interests, or OY, as you will see a lot of the time, this can indicate a build-up or unwinding of positions. So I hope this was somewhat clear. Now we can switch to Tradingview in order to see a few examples on the chart in order to make everything a bit more visual. So without further ado, let's jump straight into Tradingview. Alright, so right now here on Tradingview, we're on the mobile USDT chart for the perpetual contracts on Bybit. So I personally use Bybit. So we'll be using Bybit as an example here. So some of you might remember that mobile had this very strong run up. And here in this table, we will see the overview of the funding rates. So you can, at least for Bybit, I will assume for other exchanges you will find this as well, that you can just go onto their website and find the funding rates of a specific day and specific hours. So here this happened on the 1st of December, the 2nd of December, so we can see here on the chart, 1st of December to the 2nd of December. We can see the timestamp in UTC and the funding rate at that time. So on Bybit you pay funding fees every 8 hours, so we can see what the funding rate was at every time the funding rates were being paid or received. So I did write them down here on the chart. And what we can see here in the beginning of this move up, the funding rate was still positive 0.12%, which is still normal. We still had in this move a 0.08% funding rate, which is also still normal. But here we started to move up more aggressively. The funding rates were starting to turn negative. So what does this mean? Negative funding rates, if you remember from the slideshow, this will mean that people in short positions will have to pay people in long positions. So it means shorts are dominant. There's more shorts being opened than longs. So people here in this move are expecting prices to come back down. But what can we see here in the chart? There was a little bit of reaction, but eventually we jumped up a lot, but a lot higher, squeezing these shorts out. I remember seeing this live. The funding fees were a lot higher in this area still, which sadly we cannot see, or you have to put on the graph, but okay, it doesn't matter too much. You can see these shorts here are just getting squeezed out and liquidated. So in the peak here, we had a funding rate of minus 1.75% even. So more people or shorts are getting liquidated. Even more people have to add here. Funding fees were a lot higher at this point. If we remove this drawing real quick, we could see here on this week, we had this on the highest week, we had the highest funding rates. And exactly on this candle, so this is a candle close. After the close, we're going down a little bit. You can see the funding rates are resetting again. So they're going back to normal, and from there prices are moving back into a neutral position or a more neutral position, not this spiky movement that we had before. So again, in the move up, a lot of people were shorting here. They got trapped and squeezed out. A lot of liquidations here. On the highest wick, we had the highest funding rates. After these fees got paid, probably a lot of people got liquidated or stopped out. Price was resetting or rebalancing, let's call it, itself again, and the funding rate started resetting. So going back to normal. Another example is on the ATA or ATA chart. This has only happened yesterday, which I thought was a pretty clean example. So we had this big run up. First we had still normal funding fees, so on this candle close, prices started moving up. We can see shorts are stepping in. So the funding rates are going into negative. Shorts are stepping in. You can see here in this extreme move up, you just gotta have to take my word for it, but the minus 3% was already sitting around these zones. They were getting squeezed and squeezed out. A lot of liquidations, a lot of stop hunts. The funding rates were going up extremely high. We can see them already here. A lot of shorts entered the market. They got squeezed, and squeezed out. The funding rates of minus 3% got paid here at this candle close / candle open. And from there, after the fees were getting paid, we saw some type of reaction and prices going back down, resetting, the funding rates going down again, back to normal or more normal levels. And if prices are moving down even more, which I won't be surprised if they do here, the funding rates will go back to these normal levels eventually. But you can see here, the funding rates were up here already quite high. They're squeezing out these short positions. Once the fees are paid, from there we see some type of reaction. So this is something that we have to keep in mind. Like right after the extremely high funding rates are paid and we see some type of reaction, it might be a good opportunity to look for a reversal entry. So for example, in this case, we could have entered maybe after the recovery of this vector candle or on the EMA cross, but that's not the topic of this video now. I just hope you do see the pattern here that once the funding rates are extremely high, shorts are getting squeezed. After they have to pay or get liquidated, prices will start reacting. So again, you could find these funding rate or the history of the funding rates on the website of Bybit itself. I will leave a link into the description of the video. I will leave another link into the description of the video of a sort of heat map where you could find the funding rates and the open interests of different coins on CoinGlass. I will also leave a link to that in the description of the video, and I will show you a little bit of that in the next video of an example trade on TRX that I took based off the funding rates. So I hope this video was somewhat informative for you and somewhat helpful for you. If there are any more questions, please let me know in the comment section or on the Discord server. And I hope you learned something today. And without further ado, I will see you guys in the next video. Take care and see ya. Bye bye.